Okay, so we're recording. Welcome, everyone. It's a 12 o'clock on the dot on November 13th. I can't believe it's November 13th. Thanksgiving is around the corner. Everyone's excited about Thanksgiving. Uh, everyone. I can't say that everyone in my family is excited about Thanksgiving, but I'm excited about Thanksgiving because I don't have to do any of the work. And we'll see everyone, and it'll be fun. We've had an interesting year in the markets, and a positive year in the markets. And we're now rounding out the end of 2025, and we have our esteemed uh, uh, market guru from Clark Capital on with us today, Glenn Dorsey. And Glenn's going to walk us through kind of like nuts and bolts of what's happened in the market, what's going on right now, and then really more of the forecast, looking a little bit over the horizon, rolling into 2026. Not that we have all the data in yet. Again, data has been delayed because of the government shutdown. I'm not sure if you realize that, but a lot of that data comes in is the government puts that together. Well, for the last 2 months, we don't have any data. So we have some things that we can follow, but that's why Glenn's here. He gets paid the big bucks to make up all this stuff and give us a good insight of what's going on in the marketplace. So Glenn, welcome again. Thank you for doing this, and give us some insight of what happened, where we are, and where we're going.
Awesome. Well, thank you, Adam, and good afternoon, everybody. I apologize for my background. I am in a Marriott by the Houston airport, so it's not ideal conditions. So it has been an interesting year. We had our little bout of volatility, February 19th to April 8th, when we were sort of leading up to all of the tariff discussions, right? And when April 2nd was the big day where President Trump came out with the tariff board. And the market from the February 19th to the April 8th low was down just shy of 20%. Yeah, it's a pretty healthy pullback. So on April the 9th, President Trump came out and said, well, we're kind of just kidding about the tariffs. We're going to push them out. And the market's been straight up really since then. We haven't even had a 3% pullback in the market since April. That's really unusual, right? You usually, I think you get 3% pullbacks in a normal year, right? And we really only had that one kind of in April. So what we've seen on the tariff front is that the tariffs that have been negotiated, and there's a framework for deals, have generally speaking been lower than what was on that scary board that I think they bought at Staples and filled in numbers right before. And now we're in the point where everything's in court now. Like, so not only do we need to deal with politicians, but we need to deal with politicians and judges and lawyers, which makes it even that much more fun. So why is it in court, right? Currently we're collecting a little bit better than $30 billion a month in tariffs, which is a big number. We used to, before these tariffs went into place, it was more like nine, right? So pretty significant increase. Now, President Trump's authority to put the tariffs in place is being questioned. He is using what is called IEEPA, which is the International Economic Emergencies Power Act, right? So he basically said, we have a national emergency. Here are the tariffs. Don't need to go through Congress, right? So that's what's being challenged. Predicting what the Supreme Court is going to rule on that's probably is difficult, right? It would appear, based on some of the questions that were asked, that they may very well say that he overstepped his bounds. Right? Now, that doesn't mean the tariffs are going to go away. What it means is that they're going to come back through different powers that are available. So there are Section 232 tariffs that can be put in place, which the Department of Commerce can say, that there is a national emergency, and then the tariffs can go back in place. Now, guess who appointed the head of the Department of Commerce? President Trump, right? So you're going to see, you could very likely see them come back that way. There are also Section 201 and 301 tariffs, which either the U.S. trade rep can say, there's damage being done to certain industries. So it's not as easy. There'll be more work that needs to go through to get all those tariffs back in place. But if you don't think that they have a game plan for that ready to roll, if the Supreme Court says he overstepped his powers, you haven't been watching what they're doing, right? I can assure you that those things will be rolled out very, very quickly after that. Um, and what's interesting is that, the fears around tariffs, everybody said, well, we're gonna have a recession and if tariffs go in place, we're gonna have inflation's gonna kick back in. Neither of those has happened, right? Inflation continues to drift down. We're sort of stuck at about the 3% level. The Fed wants to see it at 2%. But the biggest components of inflation really have nothing to do with tariffs by and large. Housing is the single biggest component, right? And there's really not a lot of direct impact from tariffs there. So, we haven't seen the runaway inflation. The economy, the last number that we had was the second quarter GDP. It was 3.8%. We still haven't seen the third quarter one because that was delayed, as Adam pointed out. So we're kind of, if you picture a dashboard of a car with lots of, say 100 different instruments, only about 30 or 40 of them are working right now. That's because the government isn't releasing a lot of data. We're relying on just private sector data, which we've always looked at before, but now that up until they just resolved the shutdown, that's really all we had, right? So you can look at payroll numbers from ADP, you can look at consumer sentiment numbers from University of Michigan, all kinds. There's a lot of information available, but a whole bunch of things aren't as well. So that should come to an end. We'll hopefully have a flood of new data to look at. But ironically, the one of the bigger ones is it's called the Employment Situation Report, which is how many new jobs were added and what's the unemployment rate. Well, we're not even they didn't pass out the surveys while they were shut down, so we're never going to know what the unemployment rate was for October. It's just gone. It's not going to happen. So that's kind of interesting. What we do know is, and I think this is one of the biggest pieces of information that still was flowing, was earnings. And the third quarter earnings reporting season is almost over. More than 90% of the companies have reported. 84% of the companies that have reported have exceeded analyst estimates. And what we're seeing is now estimates are going up. So as the stock market is near an all-time high, the S&P 500 in particular, earnings are also at an all-time high, right? And are projected to continue to go higher, right? We're looking, that consensus of analyst estimates for next year is almost 16% higher earnings next year than this year. And this year's coming in to be about 14% or so higher than last year. Right? Ultimately, that's what drives the value of a business. How much money do they make? I know there's a lot of talk about, I hear the word bubble being thrown around quite a bit. And I lived as a portfolio manager through the tech run up and then bursting of the bubble. And I can tell you there's a lot of differences from today, and there's some similarities. Similarities are, obviously that both rallies were driven by technology. Exciting technology in the 90s was, email, texting, internet commerce. Right? You had 5 years in a row that the S&P 500 was up 20% or more from 95 through 99. Today, it's being driven by AI. Right. So what you have, artificial intelligence, and this are really going to be an exciting area of productivity gains, in our opinion, and that should help drive earnings growth for companies as they become more productive. Just a practical application of it. I know you hear AI, you immediately start thinking about robots taking over the world. and that's hopefully unlikely. But you know, I was traveling. I was in an office, and we had 8 1-hour meetings in a row in there, and the advisor had a note taker, and it summarized all of the things that we talked about. It highlighted the action items that needed to be followed up with. It was fantastic. I looked at it and it was really handy. And if you think about it, it would take you 15 minutes probably to do all of that manually. 15 minutes times 8, that's 2 hours of savings just right there. So you start to think about the how that rolls out. Um, and you really can start to believe, you can have some pretty exciting productivity gains there, right? So there's the similarity, right? Technology driven. The difference is the valuations are considerably different. What we tend to look at is what is called the price to earnings ratio. So in simple terms, if you're going to buy a business and it makes $100,000 a year and you pay $2 million for it, right? You paid, basically $20 for every dollar of earnings that you got. Or stated another way, you would make your money back in 20 years if earnings never grew, which would imply a 5% return, right? So if you look at all those metrics today, the implied return, given the price to earnings level of the market today, is about 4.8%, right? And what you typically do is you'll compare that to, well, what's the risk-free treasury rate? 10-year treasuries of 4.1. Right? So there's still a premium. And we expect growth and dividends, and that changes what that return is. But you're being compensated for having stocks, right? In 1999, that earnings yield was 3.8%, and the 10-year treasury was 6.5%. Right? So there wasn't incentive to buy stocks. Stocks were very overvalued compared to uh, bonds. The second thing, big difference is what the Fed was doing. Right? The Federal Reserve raised rates 3 times in the second half of 1999, and they raised the equivalent of 4 times in the first half of 2000. Now, remember, stocks peaked in March of 2000 and then proceeded to go down a lot. And now what do we have today? Well, we've had 2 Fed rate cuts and maybe another one in December and maybe some more next year too. So you have a Fed lowering rates versus a Fed raising rates. And then lastly, and this is really important, is that earnings for the S&P 500 peaked in the third quarter of 1999, right? So 6 months before stocks peaked, earnings peaked, and then they started to decline. For the next 5 quarters, earnings decreased to the tune of 32%, right? So if you think about it now, you have declining earnings, then you have record high earnings that are increasing today. So there was a catalyst to let the air out of the bubble in 2000, and that was Fed raising rates, big valuation disparity between stocks and bonds, and companies making less money. That is just not where we are today. We think that the market is fully priced. I don't think it's extremely overvalued. We believe it's fully priced. Um, and as long as the companies continue to put earnings on the board like they're doing, uh, we think that any pullbacks in the market that you get should be, opportunities to buy. And we will have pullbacks in the market. Volatility is a normal thing, right? In fact, what we've been enjoying is the abnormal thing, which is no real pullbacks. So, when you see it, don't panic. It's actually, from our vantage point, that gives us an opportunity sometimes to add positions that we thought might have been a little bit pricey before. If a company is going to make more money and the stock price goes down, in the real world, that's called a sale. And that's what we like. If we can get the same company at a better price, and it's a good company, high quality company with growing earnings, then that's what we want to do. So that's kind of the big picture of what we're seeing right now. There's been some probably some excitement around gold. I know a lot of people are asking it about gold and talking about it because it's done really well this year. So, our opinion on that is, gold's impossible to value because it doesn't have any cash flow, right? When we buy a company or buy the stock of a company, we can look at their earnings stream, their cash flow stream, and figure out what that is worth. Gold does not have cash flow, right? So the value is purely determined by the intersection of buyers and sellers, right? And that's the type, I'm not passing judgment on whether we think gold's going up or down. I don't know because I can't value it. It's had a pretty incredible run. It's up over 50% this year. But if you look over the longer term, the returns haven't been as good as they've been this year for sure. So, it's just always a caution when you're buying something that is really difficult to value because if you buy it, you're counting on somebody else paying more than you did to be able to make money on it. And that's not what we do, right? So just throw that out there. But there, so Adam, and Jill, I'm happy to stop talking. There's a Q&A button down the bottom. If anybody has any questions, they can put them in there and we can try to answer them. But I don't know if either of you had anything.
So your gold comparison, would that be like crypto? I know we have crypto is still on not some, everyone's talking about crypto, and slowly it's getting approved where investors can start investing in their advisory accounts. Where's Clark on the crypto conversation?
Yeah, that's a really great observation, Joe. It's exactly like crypto. There's no cash flow. I don't know what it's worth. From a technology standpoint, I think we're going to see digitized everything, right? I think, at some point, if you're sending money around the globe, it's going to be way easier to do when you have kind of like a digital currency, if you will. So I think the technology is very interesting. I think it will roll out much be used a lot more than it currently is. I just don't. It's impossible for us to figure out what the value of it is. So, if I had followed my son's advice from, let's see, about 8 years ago, he said, "Dad, go all in on crypto." That's not investing, but it certainly would have gone up a lot.
So did you listen to your son?
I bought some for him just so that he could experience what investing was. That's probably more useful than some very practical way of learning versus paying tuition. So got to see that with the volatility of it. And, that's the thing. There have been multiple pullbacks in Bitcoin, for example, of over 70%, right? And over the long haul, it's done really, really well. But that's a very challenging thing to hold on to when you see it down that much.
Agreed. So let's talk about the news from last night. The government shutdown. It's over.
Yeah, the government. Yay. Yay. Well, because I have to say, having flown out of LaGuardia on Tu Monday, Tuesday. Anyway, I was happy I got out because I was very concerned about what the lines were going to look like since a lot of TSA folks were calling out sick because they weren't getting paid. I can certainly understand that. And as I said, I'm in Houston now. I really wanted to make it home, so I'm from that aspect, I'm really happy that it's solved. From a market standpoint, I think this was a 23rd government shutdown that's lasted more than a day. And the net result in the market historically hasn't mattered, right? Literally the change in the S&P during the time period that the government was shut down was essentially zero. It was, and if you look at it just from the 80s forward, it was actually positive 1%. The last shutdown we had was 35 days under President Trump's first term, and the S&P was up over 10% during that time period, and it's actually in positive territory this go around. So So I said, thankfully, we're not investing in Washington, D.C. We're investing in good, high quality companies that are making money and growing earnings. And that what happens in DC is more of a sideshow than people think. It's less important to the market than people think.
And it's interesting that you say that. I've had several meetings, lots of meetings during the shutdown, and that similar question comes up. Well, why? Why is the market not affected by the shutdown? And so, I mean, you're talking about it. I don't want to say it doesn't matter, but it doesn't matter. We're feeling it. I mean, my kid left out of LaGuardia too, sat on the runway for 4 hours before he took off. So we're feeling it, but from a market standpoint, the market's not affected by it.
No, I mean, there are certainly companies that are, if you're doing most of your business with the government and they're not spending money right now, that's a problem. But the S&P 500 has 500 companies that are exposed to all kinds of different industries that really weren't affected by this. And you can tell by just the numbers that are being reported are pretty good growth. Now, granted, that quarter ended on September 30th, so you might see a little bit of that impact in the fourth quarter. You'll know who the winners and losers are of the government shutdown game.
Right. So you talked a little bit about rate cuts. Is Clark's position that there'll probably be one more for December? I mean, a lot of the economists and portfolio managers that we're speaking to are saying December and maybe 1 to 3 in 2026. So what's your thought? What's Clark's thought on all of that?
Yeah, the Fed's in a really interesting position that they could do anything that they want. And what I mean by that is that, historically, if you had the number of rate increases that the Fed put through in 2022, right? You went from 0% to 5.25% on the Fed funds rate. We would be in a massive recession right now in a normal economic cycle, but we're not. So typically, the Fed would have to be cutting rates aggressively to save the economy from going into a tailspin. But the consumer has been incredibly resilient, right? The U.S. economy is 70% is consumer, and about 20% of it is corporations, right? So the consumers continue to spend. They're shopping, no matter what they say. Like, oh, they feel terrible. The consumer sentiment numbers are awful, and yet people are shopping like crazy. And when you see where the money's being spent, it's like restaurants, hotels, airlines, all discretionary spending type things that have been really, really strong. And the Fed has a dual mandate, right? One is to keep the economy, keep the unemployment rate low, which is a byproduct of a strong economy, right? And the economy is doing fine, so they don't really need to cut rates to give the economy any more gas because it's doing just fine at this point. And then the other part of their dual mandate is keeping inflation in check, right? And we're still above the level that they want at 3%, but it's currently about 3%. And their target's 2%. But that's kind of an arbitrary number. When they put that 2% target in, inflation was below that. And they said, well, we'll be willing to let inflation run above the 2% level so that over a really long time period, it kind of averages it at 2. So they're in an unusual position. They don't need to do anything. Arguably, the Fed funds rate, which is what they set, is higher than it needs to be. It's slightly restrictive. So that in our opinion, they probably could easily lower the rates and not worry about, we don't think that's going to trigger a next wave of inflation, right? So there's been some contentious moments in the relationship between President Trump and Chair Powell of the Fed. Not unusual. Every president wants lower rates. President Trump arguably maybe a little bit more vocal than some in the past about it. And I think to some degree, Powell may have dug in his heels a little and waited to start lowering rates. His term is up in May, so we'll see. We'll see. Hopefully, politics isn't driving any of the decisions, and that they do what is right for the economy. Like I said, they're in an unusual position that they don't really need to do anything, and the economy should be fine. There has been a slowdown in hiring right? We've definitely seen a slowdown in the hiring rate, so we need to keep an eye on that. But the unemployment, that best that we can tell, has not really picked up, right? So, again, the economy seems to be doing okay.
Hey, Glenn, question came in, and I have a couple other ones to kind of fill in, but since this one just came in, um, it's more of a planning question actually about like how to purchase my first home and strategies. But I think where it could help with you is if someone was going to be putting money away for their first home. Obviously this is based on a time horizon standpoint. Where from a portfolio management standpoint, where would you have that money going and investing? And the second part of the question is more if you've known anything about the 50-year mortgage piece that's been floated out there, and if that's actually going to be a real entity, a real product that will happen.
So the first question, where do you put your money when you're saving, is very much a time horizon thing. If you think you're going to be buying a house in the next couple of years, you shouldn't take the volatility risk of stocks, right? I would think in that instance, you really want to be in something very short term, like money market or CDs or T-bills, something that you don't have any risk of being, needing the money when the market's down. If you're talking about, you know, 5 to 10 years, you're going to buy a house, then yeah, you've got some runway to be able to utilize, stocks in that equation. Um, the the second question, is 50-year mortgage a real possibility? I think it might be. Um, and the interesting thing is that it will certainly make the mortgage payments more affordable to more people, and that would be helpful to many. But the flip side of it is, if you think about how much money you're going to pay in interest over the life of that mortgage, is going to be staggering, right? So, if you can avoid a 50-year mortgage, and make the payments on a 30 or even a 15, you're much better off financially to do that. It really comes down to, can you actually make those payments? Right. There was talks before about having 100-year bonds for the government. That would have been brilliant when rates were low. They should have issued those. It would have been the right thing to do, but they didn't.
Yeah, from a planning standpoint, I used to do those calculations way, way back, and this is getting into a more macroeconomic conversation. But if you add in lost opportunity cost, and depending on what your rate of return is on your money, your best investment, and then you look at your interest rate on your mortgage, that's where there's an inflection point. So I've actually run it in the past where a 50-year mortgage would be awesome, depending on what your best rate of return on your money outside. If you have a 5% mortgage at 30 years, but your rate of return on your money outside is making 8, give me a 50-year mortgage all day long. Take the
Oh,
spread.
absolutely. Yeah.
So it's really, so again, thank you for the question. It's a planning question, and so that's where, when we're talking about markets and we're talking about portfolio management, we're talking right now time and sentiment of what's going on in the market right now. Our job as planners at Forefront is to really watch your six, watch your back, and make sure that you have the right plan in place. Make sure you have the right protections always in place, and then challenging you what's your future going to be. And then the conversation that happens quarter to quarter or every 4 or 5 months is making sure that we're staying on track with your plan. And then depending on what the market sentiment is, when this year, which is interesting, this year, and even last year, our clients aren't questioning should they be in the market. They're cheering, they're raising their hands, they're excited. But the client reviews we had in April, different story. but we'll have those reviews again in August and September. And when we point out, oh, by the way, your portfolio was down 10% in April, they don't remember. And that's not indicative of our clients. It's indicative of all clients. People have short-term memories of downtimes, especially when there's exuberance on the upside. So, so our job is to kind of play that psychiatrist, psychologist, coach, and mentor to keep you on track and put things in perspective. But with that said, from going back to portfolio, we have one question. I'm trying to frame this into a question because I know who it's from and I know kind of what they're getting at. I think it's more along the line of going back to the currency question. And if the US currency flips to digital, what's the impact on one, do you see that happening anytime soon? And again, this is an opinion question, probably. I don't think that you have the crystal ball to figure out if it's going to go. And in my opinion, it's not going, the US currency is not going away anytime soon, but what's soon? But when it starts to go digital, what's the impact?
I think you really need to think about it more as a way to move, way the money moves, as opposed to a replacement of it, right? I don't see the green dollars disappearing magically anytime soon. I don't think it's going to get replaced by another country's currency or any block of countries' currencies. No, in order for a currency to be useful, it needs to have a very deep and liquid sovereign debt market, meaning, we have treasury bills and notes and bonds that are out there that trade in, gigantic numbers and volume. No other country or block of countries has that. China doesn't really have much of a bond market established at all, and quite frankly, their currency isn't free floating. They fix the level that it is. So China's not going to take over that position. Europe, while they have a unified currency in the euro, each country has its own debt market. So there's no big eurozone debt market to support it. And then, you think, okay, well, is Russia and India and China and all of them going to get together and try to displace the dollar? Well, you know, I wouldn't buy that currency, frankly. I would feel a lot more comfortable with the US dollar. So again, I think the digitization will happen. Sending money around the world is clunky right now, is the best way to say it. And look how easy, those of us with kids, how easy it is to transfer money via Zelle or Venmo, which we do on a regular basis when they need money. It should be that easy with sending money around the world, but it's not really, right? So yeah, I think it's inevitable that it will. Clearly, the current administration is very supportive of digital currencies. I think you'll see kind of money market like, these stable coins, as they call them, that'll be backed by treasury bills or something like that. I think that's kind of where the world's moving, but I don't think it changes the value or usefulness of the dollar.
And then I don't see anything else in there. Please, we have a couple more minutes with Glenn. If you have another question, thank you for your questions. Please put them in the Q&A. Question that is coming up, and just based on the reviews that we've been having lately and looking at the data, just the overweightedness, if that's the right way to put it, of the S&P, and the fact that we really have about 10 companies that represent 40% of the value of the S&P. And it's one of the reasons why Forefront has a thesis that we believe, especially for our clients that have money, which majority of our clients have wealth, and you've done very well for yourselves because you worked really hard, is the fact that we want to be in individual securities and not being in indices, because the indices are a misrepresentation of really what's going on in the market, one. And two, you can get hurt if all of a sudden something switches because of the overweightedness of certain companies in the S&P. or any of the indices. But is there anything that, from a standpoint, is there any way, from a planning standpoint and a portfolio management standpoint, we use the S&P as like this benchmark, but we shouldn't. It's kind of a invalid benchmark anymore because of the overweightedness. Can you walk us through in simple terms why the S&P is this overweighted as far as an indice, why they've let it get to this point, and how do we plan around that from a planning standpoint?
So I'm going to go with the word concentrated. I like overweightedness, but that's harder to say. Yeah.
So concentrated overweightedness.
Yeah, concentrated overweightedness. Yeah, it's so the S&P 500 is what's called, so it is a market capitalization weighted index, meaning bigger companies have a bigger impact on the return. So when you see the S&P 500 up or in today down 1%, the bigger companies are really driving that change. It has become very, very concentrated. To right, it's about 40% for the top 10. And quite frankly, from a diversification standpoint, that's more concentrated than we would want in our portfolio. So when we're building the portfolios, you're going to see smaller weights than that for the top, your top 10 holdings. There is an S&P 500 equal weight benchmark, which I think is a better way to look at it, frankly. And I'll typically mention that. So what it does is takes the 500 stocks that are in there and gives them each the same weight. So NVIDIA, your biggest company, has the same as the smallest of the 500. So that's a more representative, I think, of what a diversified portfolio should look like, right? Than that very concentrated S&P 500. And from I think from a planning standpoint, again, you don't want, I think this is exactly why you don't just want to buy the market, right? That you want to be selective, because I can assure you, if you looked at the 500 companies in the S&P, you'll note a whole bunch of them aren't very good. Many of them are losing money. Why would you want to own those? And you own everything when you buy the market, by an index fund or something like that. You're buying the good, the bad, and the ugly, right? And you look at a situation like tariffs. There are winners and losers in the tariff world, right? There will be companies that are unaffected. Like, think about financial services, not really tariff impacted, right? Versus somebody that's heavily dependent upon the things that they sell and they're importing them, right? So, we can be selective when we actively manage the portfolio. That to us makes a lot more sense than just kind of broadly owning the market, particularly when it's this concentrated. So I think we need to. The first battle was we moved away from talking about the Dow with clients, which is 30 stocks. It's price weighted, so that if a company does a stock split, it becomes a smaller part of the Dow, which makes none of that makes any sense at all, right? So the first battle is, let's not look at the Dow, let's look at the S&P 500. Now the next step, I think, is, well, why don't we look at the equal weighted S&P 500, because that's a better representation of what a diversified portfolio should look like.
Wow. So all of a sudden we have a flurry of questions coming in. So we want to be cognizant of everyone's time. But the first question that came in, and we'll get to both. So, but the first question that came in, I think, it was one of the questions I was going to end with. So, things are going well. We've had great markets, except for the COVID and 2022. Remember, everyone, 2022 was a really, I think that the technical term, shitty year for markets. So bond and stock markets were not good in 2022. I think that's the technical term. It's kind of like overweightedness. But anyway, but right now we have this trajectory where there's a lot of tailwinds behind the economy and the market. Crystal ball, and I've had this conversation with clients as well. And I like, the known knowns are, something blows up in Asia and we have a war with China. We have the Ukraine war, just it really pulls in Europe and it turns into a World War III. the Israeli conflict, and it really takes the Middle East, and those areas seem to be more under control and tamping down. But those are the known knowns that if all of a sudden they blow up, that's going to potentially impact the market negatively for a short period of time. Anything else that you see or that Clark from a projections out there, like, hey, you know what? If we zig or zag here or there, we could be on a different slope.
I'd say the one thing that we're keeping an eye on that could potentially be a problem is the private credit market. So there's been a lot of money flowing into that, and there's been a couple of pretty high profile problems in that space. Whenever a lot of money goes into one area, generally speaking, you'll see the quality of what is available goes down, right? So private credit, if you know, is kind of companies borrowing money not through the corporate bond market where there's a lot of regulation that's kind of going through the private channels, and there's a lot less disclosure that goes along with those. We did see the market react a little bit when it was one of the high profile ones filed for bankruptcy, and some lenders got hurt with that. So I think that's just an area to keep an eye on. I'm not overly concerned about it. Our bond desk usually they get a lot of good information. They can hear things that the news isn't making the news channels. The bond traders will be talking about stuff. So I'd say that would be the one area that would fall in that category. I think that you were highlighting. But I think we need to keep an eye on the labor market, right? So that as I said, that there's been a slowdown, if not almost a hiring freeze, but without a huge pickup in layoffs. So now that one of the numbers that we watch really closely is contained in what's called the Job Opening and Labor Turnover Survey report, which we shortened to JOLTS because that's easier to say too. And now that will start to be released as well. But there's embedded in that is a layoff and discharge rate. And that's something that we really want to keep an eye on to make sure, there's definitely a subset of the consumer that's struggling. They kind of talk about a K-shaped recovery, meaning there's the haves and the have-nots, and that's frankly always the way it is. The people that don't have money are ones that struggle the most. But areas that are buy now, pay later kind of thing, those are the areas that will fall apart first in a weakening economy because the people are barely getting by as it is, right? So we keep an eye. That's could be a warning signal that maybe the economy is slowing down faster, and then that could spread. So you always, as good as conditions are now, you're right. We always have to be thinking about, well, what could go wrong, what could derail this little happy market that we have, and there's a couple of things I think that we're focused on.
You were just talking about the labor market, and the last question that came in, and even while I was on here, I saw a journal like Verizon is laying off 14,000 people. They have these layoffs happening all the time. And I'm not saying Verizon has these layoffs happening all the time. Just markets in general, corporations in general will have layoffs that are happening. And so we see these big numbers at times, like 10,000 laid off here, 14,000 laid off there. Is this something that I know we don't have the data, we don't have the government data for this, so there's a part of that. But based on the data that we've had and the numbers that are coming out, and based on your experience in the market, I think that the fear is the AI world. And we've had this conversation with clients is, AI coming in, and as you articulated, saves an advisor 2 extra hours of his day because you can do all these meetings. We use Note-Taker all the time, and we use AI where we can to be more efficient. But there's going to be some companies that are going to start using AI intelligently, and it's going to eliminate entry level positions potentially, or really paper pushing jobs, new jobs like in the McDonald's. There's already a mandate out there from them that they're looking to automate all McDonald's so that they can have one employee in a store because they can run everything else through AI. That's their mindset and that's the goal. This is going to impact the labor market. Will that then have a negative effect on the markets?
So, the best layoff information that we've gotten now, the company called Challenger Gray and Christmas puts out a monthly figure. They tally up all of the announcements, and last month it was 153,000, I believe, was the layoff number, which is a big number. Keep in mind that the labor force is almost 170 million people, right? So when you start to think about, well, is that a big number in terms of that of the 153,000 isn't that big when you compare it to the labor market as a whole. And you're only going to hear about the layoffs, right? In many cases, they're laying off, but then they're hiring in another area of the company. So yeah, you're absolutely right. It's going to AI will impact initially the more entry level type jobs, right? It's ironically, the area that it's showing up the most is like for computer programmers, because the AI we could tell AI, hey, write me a program that does this, and it can do it, right? So interestingly, one of the bigger areas that's been impacted is technology. The same was true when the internet revolution happened in the 90s. Everybody was talking about all the jobs that were going to be lost, and I think the final numbers were something like there were 3 million jobs lost because of the tech revolution then, and there were 12 million jobs created. So I think you'll see something similar in that regard, because somebody needs to train the models to come to the right conclusions, right? That's really, the value of people that have experience is actually going up with something like this. Just like when you hire a new employee, you got to train them to be able to do their job, and it's similar is going to happen with AI. We're doing it at Clark in a small way, something where somebody was taking numbers off of a statement and plugging it into, an Excel spreadsheet to be able to upload into our systems to analyze security, holdings and things like that. We've been working with each custodian has to have its own model so that so it can learn. So we've been trying to train these models for months, and we're getting to that point where it's maybe 90% right, which is okay. I If I had an employee that was 90% right, and then after doing their job, they wouldn't work for me very long. So, and the person that is doing that job might go away, but there's already a job where there's more, be able to use more of their thinking capability, right? So it would be one of those things that, yeah, the manual job gets eliminated, but then maybe put somebody in a better position as well. So I don't think it's a zero sum game. You're on mute.
Yeah, agree with everything you just said, and we've gone through the Industrial Revolution. So, and we've had these turnings, the steam engine, to the car. The cars eliminated horses. Horses were everyone's transportation, and they're like, oh, we don't need horses, and that eliminated jobs. That eliminated the people that had to feed the horses and clean up the streets of the horses, and made cities cleaner and better and not as smelly, and et cetera. So there are these evolutions that will happen, and they're scary at times. And using the internet or using cell phones, that they've made people more connected. Facebook made people more connected. Can you take these things and use them negatively? Sure. And they're going to be things that are taken, used negatively or positively. And that's why, we just want to work with positive people. So all of our clients do things the right way. And so, but point being is, we're not in control of all those things that are happening. We have to have faith in society. We have to have faith in our people, and just have a mission moving forward to to always going towards true north. And will there be bad actors in anything? Yes. Will there be uh, ramifications where there may be some jobs that are eliminated? Yes. But then, as I said this morning on a client meeting, I was like, it's kind of like the book "Who Moved Your Cheese." You can't just be waiting around and thinking that the world's going to stay still. It doesn't. You need to constantly be evolving, constantly be thinking about what the next opportunity is. And AI for us at Forefront is just a tool, and it's making us more efficient with our note taking and organizing some of our data that would have taken us a lot more time. By using those tools, that allows us to be in front of our clients more and be more attentive and more accessible to our clients, because we don't have to do some things. And the AI that we're using, it's not right. We still have to check it. It's not. It's, again, going to your point, Glenn. It's 80 to 90% right. It saves a lot of time, but it's not. It doesn't pick up everything, and there's corrections that need to be made all the time.
Yeah, I think going back to the job thing, look at the phone. You get directions on there. I wouldn't want to be a map maker today, right? Who's doing that, or encyclopedia maker, because you Google everything, right? I remember as a kid we had 30 encyclopedia giant books, which you tell somebody that today, they think it's hysterical, right? But all of that stuff is contained in this little thing, and so many more functions in there too. And we're still at a record high employment level, right? And arguably the phone probably eliminated a whole bunch of jobs, but created a whole bunch of jobs too.
Yep. Well, Glenn, we almost took the whole hour, but there was some great questions that came in. Great conversation today. Jill and I want to thank our clients for being here. This is recorded. It'll go through compliance to make sure any of the things that I said that were incorrect will get filtered out, so we can post it on the internet or post it on our web channel and send it out to you. We want to thank you for your questions and want to thank you for your time. Glenn, I want to thank you for spending time with us and being a voice of reason, and making sure that we're not too concentrated in anything of the portfolio, or overweightedness happens in the portfolio. So we want to make sure that that's why we have you being our voice of reason on some things here. And I want to wish everyone a very, very happy Thanksgiving. Spend time with your family, give everyone a hug, and enjoy your family, enjoy your loved ones, and turn off the TVs. Stop watching the media, so that you can actually have good conversations. Talk about sports, fight about sports, and enjoy that. Guys, have a wonderful day. Take care.
Thank you.